Welcome to the channel. Today we'll unpack a timely question for people living in high cost of living areas. Over the next 10 years, is it smarter to rent and invest, or to buy a home and build equity? To keep this practical, we'll analyze a $600,000 example property, today's higher interest rate environment, and the often missed costs of ownership, including maintenance and transaction fees. Then, we'll compare these against the potential gains from investing a large down payment in a diversified index fund. Along the way, we'll use diagrams, a table, and quick quizzes to help you internalize the key ideas. Finally, we'll close with a clear checklist and a concise verdict, so you can decide what's right for your goals. With that framing in place, let's move from the big picture to the concrete numbers. Here's what we'll cover. First, we'll set the context, who this dilemma affects, and why 10 years is such an important time horizon. Next, we'll outline the case against buying for a short stay, followed by a deep dive into the hidden costs of owning a detached, single-family home. Then we'll compare renting versus buying side by side. After that, we'll walk through a 10-year strategy timeline before acknowledging the very real non-financial reasons people still want to own. To reinforce learning, we'll include quick quizzes. We'll end with a practical checklist and a clear verdict. With the roadmap set, let's step into the context. In high cost of living markets, buyers often need substantial down payments just to get a foothold. But rates are elevated, which raises carrying costs. Renting, in contrast, can preserve liquidity and allow that cash to be invested in broad, low-cost index funds. This matters most if you plan to move in roughly 10 years. At that horizon, transaction costs can overwhelm real estate gains, whereas the stock market has historically offered strong returns across many rolling decades. With the context set, let's analyze the case against buying when your target holding period is only about 10 years. If you expect to sell within 10 years, high transaction costs are a major headwind. Between closing costs on the way in and realtor commissions plus closing costs on the way out, you may lose roughly 5 to 6% of the final sale price. On a $600,000 property, that can easily erase much of the appreciation over a decade. Meanwhile, elevated mortgage rates amplify interest expense, and property taxes and insurance remain ongoing obligations. By contrast, deploying a large down payment into a diversified index fund keeps you liquid, historically provides strong 10-year returns, and avoids the friction of buying and selling real estate within a short window. With those dynamics in mind, let's quantify the cost stack next. Here's a practical snapshot. First, the buyer commits roughly $285,000 for the down payment, plus inbound closing costs, sacrificing liquidity. The renter, by contrast, parts with a much smaller deposit, preserving capital. Second, monthly costs for owners, principal, interest, taxes, and insurance often exceed a modest rent, such as $2,000 in our example. The difference can be invested monthly by the renter. Third, owners should budget 1 to 4% of the home's value annually for maintenance. On a $600,000 home, that's $6,000 to $24,000 per year. Renters avoid those surprise bills. Fourth, transaction costs at sale can be around 5 to 6%, which diminishes short-term returns. Finally, the opportunity cost of a large down payment not compounding in markets can be substantial over a decade. With these numbers in place, let's highlight the often overlooked ownership costs. Many buyers underestimate maintenance. A common rule of thumb is 1 to 4% of the property value per year for upkeep and capital improvements. On a $600,000 home, that's $6,000 to $24,000 annually. These costs include routine repairs as well as big-ticket items like roofs, HVAC systems, and exterior paint. They are irregular, often urgent, and can disrupt cash flow. There's also the time cost of coordinating contractors and projects, which renters largely avoid. With ownership costs clarified, let's compare renting and buying directly to draw out the practical trade-offs. On the left, renting preserves liquidity, especially valuable in uncertain markets. Monthly outlay may be lower, as in our $2,000 example, leaving room to invest the difference. Flexibility is higher, which suits a planned move within 10 years. On the right, buying offers control and stability, enforced savings as principal is paid down, and a partial hedge against inflation. If rates fall, refinancing may improve affordability later. However, when the horizon is short, the frictions and ongoing costs often tilt the financial scales toward renting. With the qualitative picture clear, let's map out a 10-year strategy. A practical sequence might look like this. In year 0, keep the down payment liquid and invest it in diversified, low-cost index funds. From years 1 through 3, automate investing of any difference between hypothetical ownership costs and your actual rent. Around year 4 or 5, reassess mortgage rates, housing affordability, and your career location. Between years 6 and 8, collect on-the-ground data by visiting target lower-cost markets and refining criteria. In year 9, accumulate cash for closing and optionally arrange pre-approval. Finally, in year 10, execute a purchase with a stronger balance sheet, ideally minimizing or eliminating debt. With the strategy mapped, let's still acknowledge the non-financial reasons people love owning. Even if renting plus investing looks better on paper over a decade, ownership offers meaningful lifestyle benefits. You can customize your space, settle into a community, and diversify your net worth beyond equities. Additionally, if interest rates fall in the future, refinancing may improve your monthly costs. These factors can be decisive for some households. Nevertheless, when the horizon is 10 years, the math often favors staying liquid and renting. To check your understanding, let's do a quick quiz. Question: over a 10-year horizon in a high cost of living area, which factor most commonly erodes a homeowner's real estate gains? Is it transaction costs when selling, HOA fees alone, property taxes alone, or routine utilities? You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is transaction costs when selling, along with the closing costs on both ends. These can add up to around 5 to 6% of the sale price, which substantially reduces short horizon returns. HOA fees and property taxes matter, but they are generally more predictable and do not create the same one-time hit to equity when you sell. Next, let's try one more question on maintenance budgets. Question: what is a prudent annual maintenance budget range for a $600,000 detached home? Is it 0.5 to 1%? 1 to 4%, 5 to 10%, or only when something breaks? You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is 1 to 4%. On a $600,000 property, that equates to roughly $6,000 to $24,000 per year, averaged over time. Larger capital projects like roofs or HVAC can bunch up and create lumpy expenses, so building reserves is essential. With the quizzes complete, let's translate insights into an action checklist. Turn insights into action. First, run a rent versus buy calculator using current rates and realistic property taxes and insurance. Second, itemize every ownership cost, including maintenance and larger capital projects. Third, compare your current rent to a detailed estimate of owner cash flow to find any monthly savings you could invest. Fourth, estimate the opportunity cost of investing your down payment in diversified index funds. Fifth, stress test your assumptions against changes in mortgage rates, home values, and employment. Finally, define your 10-year plan, including your target move date, candidate lower cost markets, and savings milestones. With a plan in hand, we can now state the financial verdict. Here's the bottom line. Over a 10-year horizon, the combination of high transaction costs, elevated interest rates, and ongoing maintenance frequently tilts the financial outcome toward renting, especially when rent is relatively low for your market. Keeping the down payment invested and adding monthly savings can historically produce stronger results. That said, ownership can still be the right choice when lifestyle stability, control, or diversification are top priorities. Refinancing is a useful option if rates fall, but it should not be the primary justification for buying now. Before we wrap, a brief disclaimer. This content is for educational purposes only and does not constitute financial, investment, or legal advice. Everyone's situation is different. Please consult a qualified professional who can review your personal details, including income, risk tolerance, tax situation, and goals. With that said, let's wrap up and point you to your next steps. To recap, renting and investing the down payment often outperforms buying over a 10-year window in high-cost markets, primarily because maintenance and transaction costs undermine real estate returns. If lifestyle stability or asset diversification is your priority, buying can still be reasonable. Either way, write your 10-year plan, automate your investing, and revisit assumptions annually. If this helped, I'd love to hear what surprised you most and how you're thinking about your own timeline. Finally, let's close with a quick thank you and a call to action. Thanks for watching. If this clarified your housing decision, please like the video, share it with someone who would find it useful, and subscribe for more evidence-based financial content. Most importantly, tell us in the comments how you are approaching the next 10 years and what you want us to analyze next.